start. Okay, hello, welcome back. We are doing taxation again, very important part of fiscal policy, which is very important part of economics syllabus for GS. And we know when you read the past papers and when you go through the past year questions, especially prelims, you will realize that a lot of questions come from fiscal policy, a lot of questions come from monetary policy, a lot of questions come on taxation, right? So this is the crux, this is the core of it we are doing, and we learned a lot of new concepts. What are the concepts did we learn? Can you recollect what are the concepts? So we started with direct tax, indirect taxes. Direct taxes, the incidence and burden cannot be shifted. Indirect taxes, the incidence cannot be shifted, but burden can be shifted, and when it is shifted, the incidence and burden lie on different people. In direct tax, the incidence and burden lies on the same people, right? Then we went to direct tax. Direct tax mein we saw ki what are the examples of direct tax: income tax, wealth tax, etc. Corporation tax is separately, like I told you, it is income tax only, but income of corporates. So that is why it is separately classified as a corporation tax. Then we read about income tax return. We saw there are 5 heads of income, salary and etc. The most important head is capital gains, yes or no? It can be short term, it can be long term. Now quickly tell me, indirect taxes are dash in nature, progressive or regressive? Indirect taxes are dash in nature, regressive in nature. Indirect taxes are regressive in nature. Why? Because they burden the one who is having lesser income compared to the one who is having more income. Yes or no? Very simple. Next what are direct taxes? Direct taxes are progressive in nature. Yes or no? They are progressive. As the income increases, your slab increases, your rate of taxation increases. Right? Are these taxes automatic stabilizers? Yes. Direct tax is an automatic stabilizer. Why? Because as the income increases, more and more tax starts coming out and less purchasing power is remaining with the person. See, bear in mind, we are not talking about the absolute figure here. We are talking about the percentage, or we are talking about the proportion here. Okay? This is fine, very good, understood. Then we saw some very important concept, which was tax to GDP ratio, right? What do you mean by tax to GDP ratio? Tax to GDP ratio is nothing but the proportion of taxes to GDP. Yes or no? Simple, very simple to understand. Proportion of taxes to GDP. Do you remember what taxes are included in tax to GDP ratio? Both direct and indirect taxes, all central and state government. Then we also discussed some percentages. So India's combined tax to GDP ratio, center states combined, is how much? Around 16 to 17%. How much is the center share? Around 10%. Okay. So just imagine 100 rupees we are producing GDP and only 10 rupees is coming as tax. At least it should be 20-25. We discussed OECD average is 34%. Yes or no? We discussed some developed economies have as high as 40-45%. Okay. Then what is the major reason for lower tax to GDP ratio? What is the major reason? Because we have something called as exemption, and exemption is given to which major income? Agricultural income. Agricultural income is exempt. No tax is levied on agricultural income. Yes or no? Agricultural income is exempt under section 10(1) of Income Tax Act 1961. Are you able to recollect all these things? Are you able to recall all these things? If no, then please revise the previous lecture and then we can move ahead. Okay. After tax to GDP ratio, we saw that how to increase tax to GDP ratio. So we can either widen tax net or widen the tax base. Yes or no? What is tax net and tax base? Tax net and tax base is nothing but the proportion or the number of things which are taxed, the number of people who are taxed, all those. If you widen the tax base, which means you are including more and more people. So one of the examples I showed you, you can widen the tax base by reducing the exemptions. So today, let's say all farmers have exemption. Tomorrow, if you say ki only farmers who are small and marginal farmers are only exempt, large farmers have to pay taxes. Then what does it mean? You have widened your tax base, and you have included some proportion of farmers also in the tax net, right? Then you have to increase the efficiency of collection. Yes or no? You have to increase the efficiency with which you collect taxes. Okay? All these result in what? All these result in tax. All these result in a greater proportion of GDP being collected as tax. Yes or no? What happens? What do you call the phenomena where tax increases more than in proportion to compared to increase in GDP? What happens? What do you think happens? What happens when tax increase more in proportion compared to a change or increase in GDP? What do you think happens? We call it as, what do we call it as? Tax buoyancy. We call it as tax buoyancy. Yes or no? We call it as tax buoyancy. So when I say tax is not buoyant, which means tax is not increasing as expected compared to increase in GDP. Okay? When when doctors administer medicines via injections and all, they monitor the patient over 2 hours, they see whether changes are happening or not. So if the medicine is not taking effect, which means that it is not buoyant, compared to the change in GDP, it is always in comparison to change in GDP. So if GDP, let's say, increases by 15%, you tell me whether tax is buoyant or not buoyant, more buoyant or less buoyant. I tell you GDP increases by 15%, tax increases by 12%. Is it buoyant or not buoyant? GDP has increased, tax has also increased. Is it buoyant or not buoyant? No, it is not buoyant, because GDP has increased by 15%, tax has only increased by 12%. It is not buoyant. Okay, when will I say that tax is highly buoyant? When GDP increases by 15% and let's say we find out tax increases by 28%, oh, then buoyancy sets in. So our objective as a fiscal policy, as an administrative officer, as an economist, is that we have to work for finding ways to increase tax buoyancy. Yes or no? Why are we doing all this? Why all this tax mehnat? Why are we doing all this? To increase revenue receipts. Why revenue receipts we are increasing? To increase total receipts. If total receipts increase, what will happen? Fiscal deficit will come down. If fiscal deficit comes down, what will happen? Government will borrow less amount of money. If government borrows less amount of money, what will happen? Then crowding out will be less. If crowding out will be less, what will happen? Private people will have more money to borrow. If private people have more money to borrow, what will happen? They will have more money to consume or more money to invest. If they have more money to consume or more money to invest, what will happen? GDP increases. The story starts from here and then again goes back to GDP. Yes or no? Are you relating all the chapters we have done till date? Basics, fiscal policy, taxation. When I introduce monetary policy, I will link monetary policy with all these chapters again. ठीक है? समझा नहीं समझा? ठीक है? This is the linkage and this is missing in books. That is why I try to teach it in a different manner. This linkage is not easily found in books. You will find various facts about tax buoyancy, how much was the tax rate 20 years ago, how much is it today, that is all fine. But why are we doing this? What is the relevance for this? Okay, in interview, someone asks, why do we need taxes? You know, many people will not be able to answer this simple question, why do we need taxes? So people say to build infrastructure, to build roads and all. But the deeper economic reason is that we need taxes to increase GDP. Simple. I showed you the link. Tax, if it will go to total revenue, total receipts, it will go to fiscal deficit, less crowding out, more money to private, and C plus I will win. And we want C plus I to win. Why? Because we saw in the last lecture, C has 55% weightage in the Indian Express article. I has 27% weightage. Total 85 to 87% weightage is with C plus I. So you cannot, in no chance you can afford or you can rely on only government or export minus import to is anyways India ka lost case, because we import more than we export normally. So only in COVID times our exports had increased more than imports because imports had reduced. Okay, so we'll speak about export and import, that X minus M part in the balance of payments chapter. That is also very important chapter, that is there in NCERT also in some basic way. Did you understand this? Now tell me, what is tax expenditure? What do you mean by tax expenditure? What is tax expenditure? What do you think is tax expenditure? Tax expenditure is nothing but sum total of all the subsidies, concessions, deductions, exemptions given by the government to the people. Be it direct, be it indirect, it is known as tax expenditure. Yes or no? Very good. Are all people liable to pay income tax? No. We have limit system up to 2.5 lakhs, up to 2,50,000, there is no tax. Bear in mind that these limits differ from age to age also. So if you are a senior citizen, more income would be exempt. Yes or no? Because government wants you to save more. There used to be separate rates for men and women also. Earlier there used to be separate rates for men and women also. Now it is discontinued. Now it is just irrespective of your gender, age is the criteria. So if you are less than 45 years of age, then something. If you are more than 45 or more than 60 years of age, something. If you are a super senior citizen, 80 plus, then you have different rates. Then up to 5 lakhs you don't have to pay any tax, because we need to encourage their savings. Yes or no? Simple. Tax is done. Do you understand the direct or income tax concept? Ki why do we use tax? Where do we use that tax? What are exemptions? What are this thing? Okay? Now we move on to something complicated. Now we move on to something technical. Now we move on to something which the issue which India faces with tax administration. Before that, what do you mean by tax avoidance? What do you mean by tax avoidance? What do you think we mean by tax avoidance? Any idea what is tax avoidance? Tax avoidance, remember the three key terms. One was tax planning, which is fairly legitimate, it is legit, it is legal. Government encourages you to plan your taxes, government encourages you to save, government encourages you to save, save your money and invest it wisely and save taxes, which is fine. Then the opposite end of the spectrum is what? Tax evasion. You are evading taxes. It is completely illegal. It is misuse of it is not following the law. And then somewhere in between, where there is no black or no white, it is grey in nature, is called as tax avoidance. You try to avoid tax, right? Now that may be legal, that may be illegal. You try to misuse the law. See, literal interpretation will say that you will get this deduction, but the substance of the language will be such that you are not eligible, but still you say that I am eligible. Okay, there are various techniques of tax deduction, tax exemption, tax avoidance, tax planning and tax evasion. Right, so when I was giving my CA final exam in 2015, we got a 2-mark question, 2-mark subjective question in our direct tax paper. We have two papers, direct taxes and indirect taxes. So in our direct taxes paper, I remember I had this question for 2 marks, subjective paper, not MCQs. 2 marks ka this was the question. Differentiate between tax planning, tax avoidance, tax exemption, and suggest ways to reduce them, reduce the avoidance and evasion part. This was the 2-marker question, and since then I know these terms by heart and I had prepared it well, so I wrote that answer pretty well. But these terms are important because these terms are coming in newspaper, and in our reading, editorials especially, you will find these terms when an editorial comes on tax and all. Okay? Chalo, very good. Now we will speak about, now I am going to talk to you about something very complicated. So are you ready for it? Are you ready for something very complicated? Are you ready for something very, something which you need to understand a lot of things? Okay, chalo, let us start. Very important. Slowly we will go. We will not rush into this. See, I told you corporate tax, income tax is same, depending. And tax is on what? Tax is on revenue or on profit. Income tax is on income or profit. Remember? Tata Group, I hope you know Tata Group. Tata Group is a big conglomerate. It has a lot of companies. Tata Steel, Tata Motors, Tata Telecommunications, everything. Okay? Tata Heavy Industries, Tata Chemicals, Tata Consultancy, TCS. Right? There are so many companies. Yes or no? Very good. Now, Tata Group, do you think Tata Group operates only in India or outside India also? Outside India also? There are two countries. This is India. Tata Group operates in USA also. Okay. Tata Group operates in Ireland also. Okay. Okay. I told you that, so Tata Group is operating here, Tata Group is operating here, Tata Group is operating here. Now what does normal logic say? Normal logic says that the income which is earned by Tata Group in India will be taxed in India. The income which Tata Group earns in Ireland would be taxed by Irish laws. The income which Tata Group earns in USA will be taxed with American laws. Yes or no? Because it is being produced there, it is being earned there. Similarly, if Amazon earns income in India, we will tax it. If Amazon earns income in Ireland, Irish people or Ireland laws will be applicable. Simple so far. Now things get very interesting. Tata Group realizes ki, see, ultimately income is what? Accounting. Na? You account for your sales, you show your facts and figures. Na? Books, hai na? They are registers and all. Nowadays it is in soft copy, it is all in computer, but ultimately they are financial records, statements and all. Tata Group tries to manipulate it. Tata Group, now tell me, if Tata Group as a whole has to pay less tax, okay? India mein tax rate is, let's say, 30%. India mein tax rate is 30%. USA mein tax rate is 28%. Ireland mein tax rate is 12%. Okay? You tell me if you are the chartered accountant, if you are the CA who is appointed by Tata Group as a global head, so you oversee all the accounts, India, Ireland, USA accounts. Now you tell me, if you want to fudge the numbers, if you want to, miscalculate the numbers. Where will you show highest profit? Will you show highest profit here, highest profit here, or highest profit here? Tell me that. We will show highest profit here. Where we will show highest expenses? We will show highest expenses here, yes or no? So overall group level pay, you are paying lesser tax and you are showing high income, high expense. When you show high expense, income, as per law, expenses are allowed as deductions. I told you, ki revenue is not taxed, but your profit is taxed. So you will try to show highest expenses here so that your Indian income goes in loss, yes or no? And that Indian income you will show कि I have earned in Ireland, yes or no? So you will try to show less expense here and more income here, and when you show more income here, what will happen? What will happen? It will result in high profit here. When this is taxed at 12%, you will be like, okay, 12% let us give it. When they see here, when they see 30%, you will show loss. So income tax authority in India will come and say ki, give us tax. You say ki, sir, we have loss in India, don't pay tax. And when you go to USA, same strategy will apply to USA also. So USA ka revenue goes to Ireland, India ka revenue goes to Ireland, yes or no? In the books. See, in reality, Tata has sold 10 trucks in India, but it will show that it has sold 10 trucks in Ireland. Okay? So you might be thinking, is it so easy to do that? It is not so easy. It is very complicated, and that is why we CAs exist. And we have given 5 years worth of our every ounce of blood and sweat to do this. Okay? This falls under tax evasion, and some of it might be legitimate, some of it might not be. So some of it comes under tax avoidance, some of it comes under tax evasion, but nothing comes under tax planning. Trust me, this is not the perfect picture. Perfect picture is whatever is earned here, you give, whatever is earned here, you give, whatever is earned here, you give. Understood? Is it simple? Okay? I'm teaching you some very important concept which is in news, which is most relevant to you, and you have to understand this. Okay? We started at 1:30. 1:13, 10 minutes ago. Okay? So now tell me, which government is losing money here? Which government is losing money here? Is India losing money here? Yes. Is USA losing money here? Yes. Which government is gaining tax? Ireland. See, because initially it had to take 12% tax on only 1,000 profit, but now you are showing 10 lakhs as profit, so it is getting more tax. Ireland is gaining, India is losing, USA is losing. Yes or no? Can I say I have shifted my profits from India to Ireland? My profits which I wanted, see how to do this and all that you cannot ask me officially in live class, in recording. Okay? Even I don't know, this is way too complicated, so even I don't know. I know few tricks, but okay, they are general knowledge. Okay? So Ireland has gained, India has lost, USA has lost. Do you agree with this or not? Can I say profit has shifted from India to Ireland, profit has shifted from USA to Ireland? Yes or no? Yes. What is tax base? I told you what is tax base. What is tax base? The number of people or the number of things which are taxed in India, right? So for this year, usually what happens is Tata Group included in India's tax base. Yes, it is included because it is taxed by Indian authorities, right? But this year it is showing as loss. So this year it is not counted in tax base because it is not paying income tax. Yes or no? Because it has run a loss. Okay? So can I say India's tax base has reduced by one Tata Group in this year when it is showing loss? India's tax base has been reduced because Tata Group is not paying tax in this year, current year, in this arrangement. Yes or no? Why tax base has reduced? Because it has shifted its profit to Ireland. Yes or no? Illegally it has done that. Do you agree with this? Yes. Using sophisticated accounting techniques, complicated accounting techniques, what they have done is they have shifted the profit to another country. What they have done is they have reduced the tax base of USA and India. Yes or no? Because now that company is not taxed in India because it is showing a loss, not taxed in USA because it is showing a loss. All of its profit it has shown ki it is earning from Ireland. Yes or no? So can I say it has shifted profits? Profits are shifted here. How are profits shifted here? By showing lesser expense and higher income here. How are profits shifted? By showing higher expense and lesser income here. Same goes for here. Can I say India and USA ka base has reduced? Can I say base has reduced? Do you agree with base reduction? Do you agree with profit shifting? This phenomena, we come to the term finally. I hope you understood the process. This and same goes for all other multinational corporates. We had just taken India ka example. Amazon, let's say Amazon, whatever Amazon earns in India, it is, if it is showing that it has earned this profit from, let's say, Pakistan, then tax will be taken by Pakistani tax authorities, right? Not Indian ones. Okay? This phenomena, this phenomena where base is reduced and profit is shifted, which results in loss of tax revenue to India, loss of tax revenue to USA, but gain in tax revenue to Ireland, is called as, is called as, very important, most important, hottest term in tax, is called as BEPS, base erosion profit shifting. It is called as BEPS, base erosion and profit shifting. Did you understand how base is eroded and profit is shifted? Why it is called base erosion? Because the home countries or the country in which income is actually earned, uska base is eroded because it is not taxed there now, because it has shown a loss, and profit is shifted to some other country. समझा? Simple. ठीक है? This is now what do you think? Who will complain in this scenario? Countries with high tax rates or countries with low tax rates? Who will complain? Countries with high tax rates will complain, yes or no? Because from there the base is eroded and profit is shifted to countries with low tax rates. ठीक है? Right? Base erosion and profit shifting, BEPS. So normally developed countries have a high tax rate. We saw Denmark, France, 40-45% they have tax to GDP ratio, and their tax to GDP ratio can increase only when they have a high tax rate. Today if instead of 10% we raise our tax rate to 20%, then our tax to GDP will also increase, obviously, right? So developed countries have a high tax rate normally. Sir, then who has a low tax rate? There are some countries who encourage this kind of thing. So what they will do to encourage? What do you think? If you want to encourage this kind of profit shifting, what will you do? You will keep your tax rate very low. Yes or no? There are some countries who do that. I will give you a few examples. One is Ireland, and they are to varying degrees. One is Mauritius. One is Panama, one is Cayman Islands. Okay? These kind of jurisdictions or these kind of countries have low tax rates. Why they are asking for low tax rate? Because they want more and more tax to be collected in their country. Simple enough. If tomorrow India introduces 1% tax rate, more and more global companies will show that they have earned a lot of profit in India. They will pay 1% tax. They will be happy. We will get a lot of tax, even if it is 1%, but we will get a lot of companies tax, which is not earned in India actually, but we will get tax and we will be able to develop. So these countries, they don't have any other thing. They don't have any other business activity. They don't have any other proper economy. They don't have. So these countries, what they do is, these countries reduce the tax rates to attract this kind of profit shifting. Yes or no? Now these countries, again these countries also have a word. These countries are called as tax havens. See, it is not heavens, it is not H-E-A-V-E-N-S, it is not Swarg, it is not heaven, it is haven. Tax havens. Haven means a safe place, a shelter, a safe place. So this is a shelter for your tax issues, yes or no? You are Tata Group, you need shelter from excessive taxation, so you run to Cayman Islands and you take, or you say that tax haven. Okay? Now, like I asked you, who will have problem with this? Developed countries or non-developed countries? Developed countries will have a problem because they have a high tax rate regime. USA also tax rates are high. We saw about France and Denmark, the tax to GDP was very high, so they must be having a high tax rate. So then these countries came together and then they discussed, ki, "Arey yaar, kya kare? What should we do about this? What should we do about profit shifting? Should we have any measure for this?" Now you only tell me, to have any countermeasure, the coordination of all countries is required, yes or no? If tomorrow Ireland does not coordinate with India, then India alone cannot do anything. But if tomorrow Ireland also says, if somebody is profit shifting to my territory, I will tell you, then it makes sense. I told you about, in the last lecture, I told you about OECD, yes or no? Organization for Economic Cooperation and Development. Did I tell that they are economically developed countries? Yes. Which means they have high tax rates? Yes. So OECD countries came together and they started discussing how to avoid base erosion, profit shifting. So they said ki at least, see, these countries will not sign the agreement. These countries will not agree to share the information. These countries are very reluctant because unka entire economy is dependent on this money, which is fine. So at least other countries whose tax rates are medium but still profit is shifted, whose tax rates are little bit high but still profit is shifted, at least we will sign an agreement with those countries. Okay? So that agreement was signed in 2017, question was asked in 2015, question was asked in 2016 prelims exam. That is known as OECD BEPS agreement. It is nothing but agreement to share information. So if somebody is shifting its profits to India, India will share its information to other country. Now you might ask, sir, but India is not a member of OECD. Then how did we sign OECD BEPS agreement? So OECD countries have signed this agreement with lot of other countries also who are not a part of OECD. India has signed the OECD BEPS agreement in 2015, question appeared in 2016. BEPS is in relation to what? Answer was OECD. They had given 4 options: WTO, IMF, World Bank and OECD. Answer was OECD. Very simple, straightforward. Yes or no? OECD BEPS agreement, base erosion and profit shifting. What do we mean by base erosion and profit shifting? BEPS, base erosion and profit shifting. Okay? Latest news I am going to tell you. Latest, this year only it has started, 2021, live, garam, hot, fresh. Latest what happened is OECD countries and other developed economies who are not a part of OECD, they came together and they said that this agreement is not working. I mean, it is just voluntary sharing of information. We need something definitive. We need some action to do. Okay? Now see, what can be done is if India signs an agreement and if India comes to know कि profit is being shifted to Ireland, what can India do? India will tell all the people, all the taxpayers ki if you are paying a lot of tax here, you have to pay some tax here also. Okay? So, which means what they are saying is ki you cannot say ki I am earning all my income from Ireland. You have to pay some tax here also, irrespective of your actual sales. Because since you are hiding your actual sales and showing it in Ireland, irrespective you have to pay some tax in India. Okay? This kind of agreement, you will come to know when I tell the name, you will come to know the meaning what I am talking about. So what they did is these countries agreed on a minimum or are considering, it is still in deliberations. They have not agreed yet, but broad framework has been created. It is still in deliberation. Maybe by the time you see this lecture, they would have finalized, so you would read it in newspapers. So what they did is, they said ki let us make one agreement signed by all countries and let us have a minimum tax rate. Ki at least 15% would be taxed in India, rest you see outside. So the law will come ki at least 15% of Tata Group's income would be taxed in India, rest it can show in Ireland, rest it can show in other countries, because we cannot get into the depth of it. Yes or no? So these countries are working out an agreement which will force companies to pay a minimum tax in the home country. If they are paying certain amount of tax in foreign country, then they are expected to pay minimum tax in the home country, right? I am not going into the details because that is very technical, but just notice that this is again by OECD and other developed countries, but the agreement is known as, or I'll write the full form first. See the words, see the words. Do you agree with the words? Do you understand the words? Global minimum corporate tax rate. So a certain rate, a certain percentage which will be applied. So let's say tomorrow if Tata Group is showing only 1% or paying only 1% income tax, India will say I will apply global minimum corporate tax rate 15%, so you have to pay, 15% you have to pay, irrespective. Okay? Now what will be the modalities, what will be the conditions, what will be the now obviously if there are genuinely, if Tata Motor is having a lot of sales in Ireland, then of course it will be exempt from this. They will work out the technicalities, don't worry about that. But notice the principle they are doing. So every country is coming together and then hammering out a global minimum corporate tax rate. Okay? So it is like you ask money from your mother, then you ask money from your father, then you ask money from your grandfather, then you ask money from your grandmother, and they don't know that you are asking money from each and every one of them. This is like they coming together and then they saying, yeah, what are you asking money from us, where are you hiding? This is like that. All countries coming together and saying ki minimum itna hona chahiye. As of now, this is in discussion, it is supposed to be 15%. This might be upwards revised, this might be downward revised, this might be changed for some countries. It is still in discussion. Global minimum corporate tax rate, GMCTR, global minimum corporate tax rate, latest hai, new hai, it is very, very, very fresh in news. This might come in 2021 prelims and this might come in 2022 exams also. It is very, very important. It is very, very much in current. Biggest topic, hottest topic is global minimum corporate tax rate. We will read something about it and then we'll try to understand whether we know this or not. Okay, I'll minimize this. I'll open net hai. Yes, we have net. See, I have not searched this, so I'm just doing it in front of you. ग्लोबल मिनिमम कॉर्पोरेट टैक्स रेट, ठीक है. न्यूज में तो कुछ नहीं है, दे डोंट यूज फुल फॉर्म. See, global minimum corporate tax. The world's financial leaders will endorse on July 9-10 coming to a deal setting a global minimum corporate tax and call for technical work to be finished so that they can approve the framework. So their target is they will approve it in October and it will be operationalized by 2-3 months. So by the time you give your exam, this is in news and this is very current. Okay? After many years of time pass. Stable international tax architecture, it made no mention of a specific rate, which remain to be agreed by nearly 140 countries, known as the inclusive framework, which is fine. See, G20 OECD inclusive framework on base erosion and profit shifting, BEPS. Do we know all this? Yes, we know all this. Okay? So now, ye ho gaya. Right? You can read this and you will come to know what I am talking about. Now, why this? Why the need? And I told you this is by OECD also. So there is another group called as G7. Group of 7 countries, they are also financially advanced group of 7 countries, so Italy, Britain and all of that are in G7. They initiated the talks on GMCTR, OECD took it up, and now there is another group which is known as G20, group of 20 economies, 20 most prosperous economies. We are a part of G20, India is a part of G20. So and G20 summits are also held in our country. So G20, then G7 initiated this, OECD took it up, now G20 is also deliberating on it. So that is why it is called as G20 OECD minimum tax rate. It started with G7. Okay? These are all groups you will learn in international relations, these international organizations. Now I'll tell you why this is happening. Simple reason why this is happening is because of 5 companies. This is happening because of 5 companies. 5 major companies do this, and you know all of them. 5 major companies do this. You know, it is very sad, but 5 major companies do this. I'll tell you which are those companies. Do you know all these companies? Have you heard about them? Google, Apple, Facebook, Amazon, Microsoft. Okay? So normally Microsoft is not included when we talk about these companies, and so what they do is the income which Amazon earns from India, it shows it has earned from Ireland. What makes it difficult to trace is, and what makes it easier for these companies to implement this is because they are global conglomerates. They have operations in more than 150 countries, right? Secondly, it is all e-commerce, it is all electronic. You notice these are all electronic, they work electronically, they don't work physically. Like Amazon gives delivery and all, but all the transactions happen on the app and on the website, yes or no? You don't go to Amazon ka shop and buy something. So that makes it difficult to keep track of these things. So it can just manipulate records very easily. So all the transaction originating from India-based internet service providers, ISP, IP addresses, they can show it as originated from Ireland. Simple. Okay? So they employ complex strategies and all of that. And please bear in mind, whenever you tax these companies, so these companies are in news for base erosion and profit shifting. Okay? So what abhi to agreement is not signed, yes or no? This agreement is still in the works. Approximate 15% is proposed by G7, G20. OECD will look into it and all of that. So what these persons do is, now what these countries do is, they have local legislations. Similar to global minimum tax rate, they have local legislations. If Amazon earns so much of money in India, then it has to pay XYZ number of tax, irrespective of whether you show your profit elsewhere or not. We have local legislations, right? So when you tax these companies due to base erosion and profit shifting, when you tax these companies, that tax is known as gafatax, GAFA. So what is gafatax? It is nothing but tax on these companies who employ complex tax evasion, tax avoidance strategies, and when they are taxed finally in India, it is called as GAFA. Why GAFA? Why GAFA? This is because of, so Microsoft is normally not included, but it is a part of this only. So Google, Apple, Facebook, Amazon, these are the GAFA tax. So if I ask you what is GAFA tax, it is nothing but tax on e-commerce companies, tax on software companies. Okay? That is the GAFA tax. Understood? Simple, easy to understand. Did you understand base erosion and profit shifting? Okay? So now what happens in, so what are tax havens? What are tax havens? What are tax havens? HAVEN, tax havens. Countries with a low tax rate regime, which are preferred by companies who earn a lot of profit in other countries, and they shift the profit to that country. How do they shift and all of that? Not important. Okay, base erosion, profit shifting ho gaya, OECD framework ho gaya. This is OECD framework on BEPS. Then we spoke about global minimum tax rate. It is still in news. It is fairly new. It has not even become current affairs yet. By July they will discuss and it will become a major current affairs. Now it is still in the inception, in the incubation stage. Okay. Then we spoke about GAFA tax. GAFA tax is also fine. Now I am going to be a little bit technical with you. You have to know this. Just the term, and that it is related to income tax. That's it. You have to know only this. Ki ye term is related to income tax, right? Now we saw that there are various various countries in which Tata Group operates. ठीक है, there is USA, there is India, there is Ireland, there are various countries in which Tata Group operates. Now, what income tax officer will see is, he will see, chalo, if I tell you Tata Group, तो you know it is an Indian company, right? If I tell you that ABC Limited operates in USA, operates in India, operates in Ireland, you don't know which company it is, you don't know whether its headquarters is in here or here, right? So how do you determine which is the home place of a company? Why we need to know the home place of the company? We need to know so that income is taxed accordingly. I'll tell you, in India, only those companies who earn income in India are taxed. Yes or no? Yes or no? So in India, you need to know which companies ka main source of income is in India. You need to know it. So how tax people know is that they find out where your company operates from. Now, where your company operates from is a very big and complicated question to prove. I will tell you, simple. Companies, 2 directors operate from here, 2 from here, 2 from here. Then what will be your answer? Where does the company operate from? You don't know. Okay? Next, companies' major sales decisions are taken here, major purchase decisions are taken here, major accounting is done here. Now what you will tell? You don't know, right? So that is why this was a confusion to find out ki where is the company situated. Ultimately, if I am in USA, company can tell ki you are in USA, or income tax department can tell I am in USA. Nirav Modi is in UK, come to know. But how will you come to know where is a company? And today, you don't even need to have a physical place for owning a company. You can just register online. You can do business from your home also, right? So, technical term I am telling. So just don't think too much over it. Just know that it is used to find out the place of management of the company, whether it is in India or whether it is outside India, and that it is used in income tax. बस इतना ही पता होना चाहिए. So there are separate rules, more than 400 pages worth of rules, which specify or which say ki how to find out where the company is operating from. More than 400 pages. Just imagine. Just to find out where the company is operating from. Because if a company is operating from India, it becomes an Indian company. So all the income which is earned by that company, if it is arising from India, it is taxed. So that is why uska source, to find the source of income, you have to find the source of company, and those rules which help you find it, those rules which are mentioned in the income tax, those rules are known as place of, see the English. Place of effective management, POEM. You only have to know that place of effective management rules are used to find the place from where company is operating, and that it is used in Income Tax Act. Finished. No need to go more in depth here. No need to know what is exactly POEM, or how to find it, how not to find it, what are the deductions, what are the exceptions, nothing. You should know that this is. So if I ask you what is place of effective management, you should say they are rules which are used by income tax authorities to find out the place of effective management of a company in India. Yes or no? Whether it is in India, or whether it is in South Korea, or whether it is in Japan, or whether it is in Mexico, you have to use these rules. This was one, place of effective management. Did you understand this? Chal. Are you ready for some more complications in tax? Something very complicated. ठीक है? Tata Group. Chalo, operating within India only. Don't worry. We are in India only now. Tata Group has a lot of companies. Yes or no? Tata Group has a lot of companies. Do you know one of the group companies is Tata Steel? Do you agree? ठीक है? Do you know one of the group companies is Tata Motors? ठीक है. Do you agree that this company provides raw materials to Tata Motors? Steel is required for production of various parts used in a car, steel, aluminium, etc. Right? It is Tata Group, which is very fancy. Now coming to commerce and coming to finance, you need to know that, remember we spoke about government companies. What is a government company? A government company which holds at least 51% shares of a company is a government company. Government is the owner. So iske badle, instead of Tata Group, I will write it as Tata Sons. Major company, big company, Tata Sons. It controls all the Tata companies. Can I say Tata Sons owns a majority stake in Tata Steel? Yes. A company can also invest in another company. Bear in mind, a company can also hold shares in another company. In economics, in finance, in commerce, company is a separate person altogether. It is a proper person. Okay? The only thing is it doesn't have a beating heart or a head. It has people working for it, but otherwise it is a proper person. It can do everything. So if I can invest in a company, so can Tata Sons, so can Tata Motors. Okay? So if I say that this company is holding shares in this company, then this company becomes a holding company. Holding. This company then becomes a holding company. Then what does this company become? Whose shares are owned by a holding company? This company becomes a subsidiary company. Again, English. Subsidiary means what? One level below subsidiary company. Do you agree with this? So this becomes a holding company, this becomes a subsidiary company, the entire group becomes group companies. Okay? So is Tata Motors a subsidiary of Tata Steel? Yes or no? It is not. It is not. Tata Motors mein Tata Steel is not holding any shares. Tata Sons is holding shares in Tata Motors. So Tata Motors is a subsidiary of Tata Sons. Tata Steel is a subsidiary of Tata Sons. Tata Steel and Tata Motors are bhai, they are fellow subsidiaries. They are known as fellow subsidiaries. They are subsidiaries of a common company. Yes or no? Who is the holding company of Tata Motors? Tata Sons. Who is the holding company of Tata Steel? Tata Sons. Who is the Tata Sons has how many subsidiaries? 2 subsidiaries. One Tata Steel, one Tata Motors. These are all companies. Chalo. Now comes the interesting part. Cars, Tata Motors makes luxury cars. Let's say they are taxed at very high percentage. And income is also very high, profits are very high, very good. Okay? What will Tata Motors do now? Okay? So Tata Motors ka sales are increasing, Tata Motors ka cost is reducing, let's say. What will happen to the profit? What will happen to the profit? Profit will increase. What will happen to the tax? More tax. Yes or no? More tax. Tata Sons doesn't like it. Tata Motors is paying a lot of tax. Do you know one of the component of cost is steel cost? Okay? Who supplies steel? Tata Steel. Tata Sons calls Tata Steel and says that supply steel to Tata Motors at double price. Supply steel to Tata Motors at double price. Tata Steel is happy. His sales are increasing. Tata Motors is sad. His profit is reducing. He goes crying to Tata Sons. He says, why? Why are you trying to reduce my profit? Tata Sons says, look at this. This we want to reduce. Complicated, huh? Tata Steel initially sold 1 kg of steel at 10 rupees. Okay? Now that cost is included here. That cost is compared with the sales. Profit is calculated. More tax. Tomorrow, on the instructions of Tata Sons, Tata Steel sells steel at 25 rupees. Same steel, same per kg. What will happen to profit? Profit will come down. What will happen to tax? Tax will also come down. Is this price natural price or artificially set? It is artificially set. This is market price based on demand supply. If Tata Steel wants to sell outside to any buyer, let's say if Eicher Motors also wants to buy steel from Tata Steel, it can get at 10 rupees. Tata Motors used to get it at 10 rupees. Okay? But since there is some setting going on, Tata Steel is now selling only to Tata Motors. Tata Steel is not selling steel to other motors at 25. Yes or no? So Tata Steel is selling steel to others at rupees 10 only. but to Tata Motors it is selling as 25, yes or no? So which of them is market determined price, 10 or 25? 10 rupees is market determined price. Remember demand supply equilibrium. 10 is the market determined price, which is an artificially inflated price, 25. Now there are two aspects. Iska tax kam hoga, his tax will reduce, his tax will increase, yes or no, because he is selling at a higher price, yes or no. But let us say Tata Steel has already a lot of losses. Tata Steel already has a lot of losses, which means it can earn profit for some time without even paying tax. For example, Tata Steel is already earning a loss of 1 lakh. Will it pay tax on 1 lakh? No, it will not pay tax on 1 lakh. Okay, it will not. After earning 10 ke badle 25 on steel it supplies to Tata Motors, his loss reduces to, let's say, 5,000 rupees. It is still in loss. See, loss has reduced, but it is still 5,000 rupees. Will Tata Steel pay tax on 5,000? No, because it is still in loss. समझ में आ रहा है? See, simple logic. Your mother and father, you have one sister or one brother. Your mother and father have agreed to give you 100 rupees per month. ठीक है? You took 100 rupees from your parents and you spent it. You notice that your sister has yet to spend that 100 rupees. ठीक है? What you will do? And you notice that she has spent 40 rupees. She doesn't need 60 rupees. What you will do? You will take that 60 rupees. Simple. He has 1 lakh before he is taxed. He is already running below water. He is already running in loss. So loss kam karo, reduce the loss, but don't make it go above zero. Are you understanding what I am saying? So set this price in such a manner ki your loss will reduce because you will start earning more because you are selling at 25, yes or no? So set 25 in such a manner that your loss reduces from 1 lakh to 5,000, but not so high that you start paying tax here. Samjha? So he has a lot of unspent loss here, and that because after zero income tax will come. After zero income tax will come ki sir you are earning profit. Now you are earning loss of minus or earning a loss of 1 lakh. Due to this 10 becoming 25, your loss reduces to 5,000 because you are selling it at a high price. Your profit is increasing, which means your loss is reducing. But then stop here. Show 5,000 profit. Last year when you sold at 10 rupees, you had 1 lakh profit, 1 lakh loss. This year when you are selling it at 25, you are showing as 5,000 loss. Still Tata Steel is not paying tax. But what is the benefit happening to Tata Motors? It has reduced tax. So if it was paying tax of 50,000 rupees, now it is paying tax on only 1,000 rupees, suppose. Okay? Who is ultimately benefiting? Everyone as a group is benefiting, yes or no? In first scenario, tax was supposed to be paid on 50,000. Now tax is being paid only on 1,000 because, can I say, iska profit has shifted here? Yes or no? Because this 25 becomes his cost and now his cost. क्या क्या मुझसे अच्छा so this 25 एक मिनट ये concept so this 25 will now increase this 25 will form a part of cost इसका cost will increase इसका profit will reduce इसका tax will reduce right now इसका tax reduces इसका loss is already so much that it can bear profit which is being earned by this 25 right which is the artificial price tell me which is the artificial price out of this is 25 artificially set or 10 artificially set 25 is artificially set. Is 10 market price or not? Is 10 market price or not? 10 is market price. Yes or no? Yes or no? 10 is market price. So can I say in normal English that this is market price? Which means if you go in the market, you will get it at 10. This is artificially set. Yes or no? Okay? Is this a technique of tax evasion? Yes, you are trying to manipulate this, right? Now what is this price exactly called? What is this price exactly called? I'll just take a break of 5 minutes and I'll come back. Okay, so we were discussing at what price Tata Steel is now selling steel to Tata Motors. Okay? See, officially it was 10 rupees. Then something happened. Tata Sons called up Tata Steel and said, "Ki you provide Tata Steel you price your Tata Steel at 25 rupees." Yes or no? What happened? Tata Motors purchased it at 25. Uska cost increased, profit reduced, tax reduced. Yes or no? This guy is not paying tax anyways. Even now he is not paying tax. We told that 25 rupees is artificially set. We told that 10 rupees is market price. Okay? So for market price, whenever we speak about market price, there is one term which we use when we speak about market price in tax. This term is known as arm's length price, ALP. What do we mean by arm's length price? It means ki don't come too close. We are not that ki we are related and you will ask for favor. Keep one arm's length and you are a stranger, I am a stranger, we are in market. Market depending on the demand and supply, we will set the price. So this is not a setting wala price. This is not a friends and family discount wala price. This is arm's length price. It is the price which is charged by the seller from everyone in the market. It is arm's length. This is market determined. Yes or no? Okay? This setting wala price, this price, because they are closely related, this price is known. Is this price a special price? Yes or no? This price is artificially set, specially set. Why? To favor Tata Motors and Tata Steel and Tata Sons altogether. This price is called as sweetheart price. You know, we say sweetheart to people in life. Yes or no? This is known as sweetheart price because this is setting wala price. This is, apna hi hai, of our own group. This is setting wala price. This is sweetheart price. This is arm's length price. So transactions have to be conducted at arm's length normally. If tax department finds out that transactions are being conducted at sweetheart price, then there will be an investigation. Yes or no? Whether Tata is manipulating prices or not. See, who is losing in this? Government is losing in this. Government is losing tax revenue, precious tax revenue. So this setting normally happens in group companies because they are able to control the supply, they are able to control the raw materials as well as the finished goods also. Normally it doesn't happen between stranger companies or between unrelated companies. Why? Because why will that person increase his tax base? Na? If Tata Steel ke jagah it is buying steel from some other company, why will that person be interested? Right? This is known as sweetheart price. This is known as arm's length price. Okay? Can I say this transaction was carried out with the intention of avoiding taxes? Can I say this? This setting wala transaction was carried out with the intention of avoiding taxes. Yes or no? Right? Now, how would the tax authority determine? How would the tax authority say that this transaction was conducted with a fraudulent intention, with an intention to deceive with an intention to reduce the tax base, with an intention to avoid paying taxes? Yes or no? Okay? So for that we have rules. But do you agree that this transaction was designed in such a manner to avoid paying tax? Do you agree with this? Yes? Okay? So this transaction was, so this is one of the ways in which tax avoidance and tax evasion happens. Now very important, a very controversial provision was added in Income Tax Act which gave income tax officers powers, to investigate such transactions. Okay? Chalo, that is one. Second most important thing, is it possible that this 25 is really genuine? Sometimes it is possible because this is a different grade of steel. This is a separate specification specifically made for Tata Motors. See, on the face of it, you will get data that Tata Steel is selling steel at 10 rupees, but to Tata Motors it is sold at 25 rupees. On the face of it, it seems that it is fraudulent. On the face of it, it seems that it is made with the intention to evade, right? But there is a slight possibility that they are all innocent. And this steel is genuinely at 25 rupees because let's say this is special, some quality is there, some specification is made which is tailor made for Tata Motors. Yes or no? Okay. Now, what is the point of debate between let's say income tax officer comes and he scrutinizes. What is the point of debate between this? In this entire transaction, he doesn't have a problem with anything. He only has a problem with 25. Income tax department says ki please use 10 rupees only in your accounting. Don't use 25. Tata Motors says I am using 25. Yes or no? Okay. So income tax department says, Tata Motors asks income tax department, how do you know it is 10? Income tax officer says I have done market analysis, I know demand supply prices, it is 10. Tata Motors gives its own calculation of 25, which might be true, which might be genuine. I am saying this transaction might be genuine, might be fraud. See, if it is fraud, it is for avoidance of tax. If it is true, if this might be arm's length price, so if someone else buys this quality of steel, it will sell at 25 only to someone else also. Is there a possibility? Yes. Okay? So, Income Tax Act has provisions for deciding these prices in advance. Do you know what these prices are called as? The prices at which either holding transfer some material to subsidiaries or subsidiary transfers some material to holding, or fellow subsidiary transfers some material to other fellow subsidiary, this price is called as transfer price. It is called as transfer price. Now that transfer price might be an arm's length price or might be a sweetheart price. Do you agree with this? If the transfer price is market determined, then it is an arm's length price. If the transfer price is setting wala price, then it will be called as a sweetheart price. Okay? This is known as transfer price. So there is a separate branch of taxation. There is a separate branch of practice of taxation which is known as transfer pricing. They only study these prices. They only determine. See, calculation of this 25 and this 10 is not that easy. We have just simplified it. So tax department will say कि as per our calculation 25 is coming, 110 is coming. Tata Sons will say as per our calculation 25 is coming, it is genuine. So it will go in litigation. Yes or no? Tax department will put a case on Tata, Tata will put a case on tax. You know this 25 is right, this 10 is wrong. So what happened was कि a lot of tax disputes arose. And I'm not saying, see, there is a possibility that this is all fraud. Yes, but there is also a possibility that this is all true. 25 is genuinely a higher quality price. So lot of disputes, lot of litigations happened, and lot of tax was stuck. You know, everything was stuck here. So 3 years ka pehle ka, you know, 3 years ago assessment is still stuck from the previous year, which was 3 years ago. Income which was earned 3 years ago. Okay. So then what income tax law was amended, and there was a provision which was added ki before start of the year, Tata Sons will submit its calculation to income tax department before start of the year, right? Now income tax department will scrutinize. If it feels ki 25 rupees is wrong, it can ask Tata Sons to change the calculation. So basically Tata Sons and income tax department will meet together and will decide on the price. Does it make sense? Beforehand only. Before this dispute arose, they will decide on the price. So let's say they decide that price should be 20 rupees. Final. Price should be 20 rupees. Income tax is agreeing with this, Tata is also agreeing with this. So tomorrow if 20 rupees pe hota hai transaction, then income tax authority cannot question Tata. Yes or no? Because they have already agreed. They have signed it. This agreement where pricing is already decided beforehand, this agreement where pricing is decided beforehand is called as an, look at the English, does it make sense? Advance pricing agreement. Which price is determined beforehand? Transfer price. Transfer price is agreed beforehand, which is known as advance pricing agreement. Now pay attention, one related concept I will tell, and then I will give you time to just digest it. Okay? Now this might be fraudulent. This might be carried out with the sole intention of avoidance of tax. Yes or no? This might be carried out with the sole intention of avoidance of tax. This sweetheart price is actually a sweetheart price. Sorry, this transfer price is actually a sweetheart price and not a arm's length price, right? So income tax officer said that I need to investigate this transaction. Okay? Earlier there were income tax officer did not have any powers. Much powers, they did not have to open the books and transact and everything. So now income tax law has given power to income tax officer to directly disconnect or directly disregard this transaction or disallow this transaction, saying it was made with the sole intention, of avoidance of tax, Okay? But do you think this is a very normal power or a superpower which is given to income tax authority? It is a superpower. Why? Because if it is a genuine transaction, and if some income tax officer has some enmity with Tata Group, then he will say ki, even if it is genuine, he will say ki, I will disallow it, I will not allow this transaction. Why? Because of my personal issues, I will disallow it because I have superpower. Okay? So there need to be certain safeguards on this superpower. So this superpower was brought in. Why? Because income tax officers were powerless. They could not solve through the maze of these complicated transactions. So the laws which give or the rules which give superpowers to such income tax officers, these laws and these rules, what power do they give to the income tax officers? They give the power that an officer can disallow any transaction which is made solely for the purpose of avoidance of tax? Yes or no? Which is made solely for the purpose of avoidance of tax? Yes or no? Okay? So such rules which give power to income tax officer, which empower him to disallow the transactions which are made solely for the purpose of avoidance of taxation, are called as general anti-avoidance rules, GAR. Are called as general anti-avoidance rules, GAR. See, anti-avoidance. To disallow transactions which are made with the sole intention of avoidance of taxes are called as general anti-avoidance rules. What was poem? Place of effective management. Why? What is it relevant for? To determine the place of management, to determine the place of control of a company, to determine taxation, income tax. What is advance pricing agreement? Agreement between the tax paying authority and the income tax department to what? To decide the price beforehand, decide the transfer price beforehand, so that afterwards litigation does not arise. It is known as advance pricing agreement. See, always bear in mind, this is normally for 3 to 5 years. It is signed for 3 to 5 years. So if the pricing is signed today, it is valid for 3 to 5 years. Okay? Then we come to general anti-avoidance rules, GAR, GAAR. General anti-avoidance rules give superpowers to income tax officers to disallow any transactions which they think are made with the sole purpose, of avoidance of taxation, hence the name anti-avoidance rules. Now there was a lot of controversy when GAR came into being. Why? Because it gave superpowers to income tax officers. Businesses and companies were saying ki, sir, you cannot empower them so much ki they can even disallow genuine transactions. Yes or no? So there are certain safeguards in GAR. What kind of safeguards? Ki disallowance can only be done by senior level officers and not junior level officers. Disallowance ke liye senior level officer have to prove that it was made for anti-avoidance and all. So there are inbuilt controls in place which are made for all these things. Is it agreed? Do you understand this? Try to understand the various terms which I have used. We have used the term market price, arm's length price, transfer price, holding company, subsidiary company, sweetheart price, artificially set, profit, more tax. All these terms we have to use. Try to focus on these terms also. Try to digest these 3 terms. Right? Yes or no? What is place of effective management? What is advance pricing agreement? What is general anti-avoidance rules? What is sweetheart price? Okay? What is BEPS? Base erosion profit shifting. I'll write it here only. Wow. Base erosion and profit shifting. What is base erosion and profit shifting? Nothing but shifting of profits from one jurisdiction to another jurisdiction which has a less tax rate. Yes or no? Okay? Now, see this. We were in BEPS. Where was BEPS? Here. Okay? Tata Group sees other countries also which are providing lesser lesser tax rate. There are a lot of countries which provide lesser tax rate, right? So now pay attention here. Can the same income be taxed twice? Can the same income be taxed twice? The answer is no. Normally in income tax, income is only taxed once. By twice I mean ki, suppose you earned in America, you went to USA, you earned there, you paid tax there in dollars and you brought money with you here in India. Now will Income Tax Department of India demand tax from you? No, because you have already paid tax once on your income. Please bear in mind that we are talking about income tax and direct taxes. We are not yet ventured into indirect taxes. Okay. So now if income tax department, so now if you have already paid tax in some other country, you are not supposed to pay tax in your home country or some other country. Okay. Why? Because this is to avoid double tax. Yes or no? See, double tax, there is no concept of double tax, because double tax is wrong. Imagine you are earning 100 rupees as salary, you pay tax 5 rupees in USA, you pay 95 rupees, you bring in India, and now your income tax department is again asking for more 4, 5 rupees, 6 rupees. You will say, sir, but I have already paid tax on this income in USA. You speak to them, I have earned it there, I have paid it there, I have come here. I have just remitted it here, I have just brought the money here, I have not earned it here. Similarly, if you earn here, if you tomorrow go to USA, if you take your savings, you transfer your bank balance to the dollar account, and there imagine if you go there, if you land there, and on the airport only Income Tax Authority of USA comes and asks you tax. You say, sir, but I have landed here for the first time, I have not even earned any income. The income which I have in my bank account is earned by me in India and already taxed in India. So there cannot be double tax, yes or no? So for this different countries sign agreements with each other ki if you are taxing that income, I will not tax. If I am taxing that income, you should not tax. Okay? Different countries sign these agreements with each other because to avoid double tax, right? Now when you have, so now imagine when India and USA sign double tax, you as an individual, you know कि your income will only be taxed either in USA or in India, yes or no, depending on the transaction. Okay? So such agreements which are signed between countries to avoid double tax, agreements which are signed between countries to avoid double tax are known as English, normal English, double tax avoidance agreement. Who are the signatories to this agreement? Who signs double tax avoidance agreement? Governments of two countries, barabar. Who signs advance pricing agreement? Who signs advance pricing agreement? Taxpayer and income tax authority of one country only. So India, Tata will sign APA with income tax department, Reliance will sign APA with income tax department. Validity is usually 2, 3 to 5 years. Then after that a fresh APA has to be signed. This avoids a lot of cases and lot of judicial problems, legislative problems. Okay? Cases, legislation. Now APA, did you understand double tax avoidance agreement, DTAA? They are agreements so that they are agreements between countries, between two taxing jurisdictions, for avoidance of double tax, which means for what? So that only income is taxed only once, yes or no? Okay? ठीक है? POEM, APA, transfer price, GAR, BEPS, DTAA, double tax avoidance agreement. Now coming to our earlier diagram. Tata realizes Ireland has 12% tax. Mauritius has 10% tax. ठीक है? Panama has 7% tax. very important concept I am trying to teach you. So if Tata Motors or if ABC Limited or if anyone wants to avoid tax, what it will do? It will show losses in USA, it will show losses in India because the tax rates are very high. Then it will show profits in either Ireland or Mauritius or Panama. Yes or no? Because all are low tax jurisdiction, 12, 10, 7. You know, there are some tax jurisdictions where tax rate is 0%. No tax, 0.5%, 1%. That in reality, today also such jurisdictions exist. Okay? Now tell me where it will go, whether it will go in Ireland or Mauritius or Panama. What do you think? Where it will show its highest profits, whether in Ireland or Panama and Mauritius? So ideally it will show in Panama 7%. Barabar? But it sees that India has signed double tax avoidance agreement with Ireland and India has signed double tax avoidance agreement with Mauritius, but there is no double tax avoidance agreement with Panama, which means ki if your income is taxed in Panama, India still has the authority to tax that income. But if your income is taxed in Mauritius, India doesn't have the authority to tax that income. If your income is taxed in Ireland, India doesn't have the authority. Why? Because we have signed DTAA. So this company will choose between countries with which India has signed DTAA. So it will demand a list of countries, it will see a list of countries, some 30-40 countries with which India has signed DTAA. Out of that, the lowest tax jurisdiction it will choose, yes or no, for BEPS. So this act of browsing through the catalogue of countries with which India has signed DTAA. It is seeing a list now. Oh, Ireland, we have signed DTAA. Oh, Mauritius, we have signed DTAA. Oh, Singapore, we have signed DTAA. Oh, Cayman Islands, we have signed DTAA. This act by the tax evader. This act by the tax evader or those who want to evade tax by shifting profits, to just see through with which country India has signed a treaty and to take undue advantage of it. See, there are genuine cases also, but to take undue advantage of it, he sees through various countries ka financials and various country ka profiles and all with which India has signed DTAA. This act is called as treaty shopping. Does it make sense? Treaty shopping. He is shopping for countries who will give him maximum benefit. Window shopping hota hai? Window shopping is just you see and what you think whether to buy or not. Similarly, he just goes through treaty shopping. He will read the treaty between India and Mauritius. He will read the treaty between India and Singapore. He will read the treaty between India and Ireland. He will choose for his particular business transaction which treaty is the most suitable. Then he'll also compare the tax rates, which out of these countries which country has the lowest tax rate, and then he will choose this is the country where I will show maximum profits. Treaty shopping. Okay? Now all this will fail. Treaty shopping will fail and BEPS will fail. When it will fail? When countries actually start communicating with each other. Yes or no? If Ireland says, see this guy is an Indian, he is showing very high profits in Ireland, but I know that in Ireland he has not made any business, he is just showing it in accounts books. If Ireland calls India and says, please catch this guy, he is your guy, but he is faking his profits here. Okay? Then we can catch that person, right? Yes or no? Today if India suspects some person is hiding in Cayman Islands or Mauritius who owes income tax department thousands of crores in taxes, but he is now hiding in some tax haven or something like that, then India will call up Cayman Islands and India will say please hand him over to us, but Cayman Islands will not agree because Cayman Islands is getting a lot of tax money from that person. Yes or no? So but tomorrow Cayman Islands might need some help from India also. Similarly, so world realizes that there is a greater need for cooperation. Yes or no? One example we saw was the global minimum corporate tax. So we agree that some certain basic level of cooperation is required, right? Whenever we ask help from someone, and if someone doesn't give help to us, we are hurt. Whenever someone asks help from us and if we don't give help, then they are hurt, right? To avoid this, we also sign some treaties and some agreements with countries you need any tax information from my country, I will give it to you. I will tell you the list of people who are paying tax in my country. If you feel there is someone shady who is your country ka person but who has come to my country, you can ask me for help. Similarly, whenever someone from my country flees to your country, or avoids paying tax in my country but pays tax in your country, you have to help me with this. So when these agreements are signed, these are agreements, these are mutually signed agreements, these are friendship agreements. So such agreements are called as English Mutual Legal Assistance Treaty, very simple. These are nothing but friendship agreements between countries. Right? Mutual Legal Assistance Treaty, MLAT. Similarly, see, it is a very small offshoot of it. Similarly, if you are, this is legal assistance, which is for all other matters also, for tax matters, other financial, other criminal matters also. So we are in the process of bringing back Nirav Modi and Vijay Mallya and Mehul Chokshi also. So these are all covered under Mutual Legal Assistance Treaty. Similarly, if you want to exchange, if you are India, you want to exchange some information with, let's say, Sri Lanka, or you want to exchange information with Singapore, and what will you give in return? In return, you will also agree to part with the information which you have. They are known as English See, I told you after 2 lectures we will just sit on a super bike and we will go very fast. This is the highest level of discussion which is required for UPSC. Beyond this, there is a deep ocean of taxation, but I am not even taking you there. Why? Because simply not required. Now, why to worry about things which are not required or which are too much? Okay? We are coming towards the end of taxation, guys, which is end of direct taxation. Sorry, not taxation. End of direct taxation. Half of that is indirect tax, but indirect tax is smaller compared to this. These are a lot of technical terms. Indirect tax में इतना नहीं है. The only fact about indirect tax is that you have to know a lot of क्या बोलते हैं, calculations in indirect tax to know how they work, to know how they function. Did you understand all of this? Easily, simple. Place of effective management, advanced pricing agreement, transfer price, general anti-avoidance rules, base erosion, profit shifting, double tax avoidance agreements, treaty shopping, mutual legal assistance treaty, tax information exchange agreements. So many things we have seen today. We have seen sweetheart price, we have seen arm's length price, then we have seen, what else we have seen? We have seen global minimum corporate tax rate, we have seen gafatax, we have seen tax buoyancy, then gafatax and all. Tax havens we have seen low tax jurisdictions, okay? Right? So many things we have seen, so many things. Now again a funny thing I will tell, simple. India, Mauritius. India tax rate 30%. Mauritius tax rate 10%. Okay? According to the agreement of, or according to the provisions of double tax avoidance agreement, we all know what is double tax avoidance agreement. According to the provisions of double tax avoidance agreement, money earned in Mauritius and taxed in Mauritius will not be taxed in India. Simple. So you go to Mauritius, you work there, you pay tax there at 10%, bring that remaining 90% here, we will not tax it. This is the arrangement of DTAA. Do you agree? This is possible? Yes. Person 1 earns money in Mauritius, pays tax at 10%, brings money to India and gives it to his mother, gives it to his father, ठीक है, gives it to his parents. Will India tax this remaining money? No. Why? Because it is covered in DTAA, double tax avoidance agreement, no tax. ठीक है? His friends are earning tax at 30%. Paying tax at 30%. They are very jealous. Ki this guy goes to Mauritius every year, he pays 10% tax, he comes to India and he enjoys his 90% income. We earn 100 rupees here, but we pay 30% tax here. ठीक है? So he says ki you also come to Mauritius. You also go there, earn and come back. Simple. DTAA, double tax avoidance agreement. His friends say ki nahi yaar, we cannot go. There are a lot of things which are stopping us. We don't have the qualifications, or we have a good job here, we have a good life here, we have family here, we have girlfriend here, we have boyfriend here, we have entire thing is here. We cannot go to Mauritius. Our families are here. We are dependent on it. ठीक है? One of them is a CA. One of them is a CA. What does he do? He works in India. He earns in India. ठीक है? He made a friend here. 2. He made a friend here. He earned money in India. He transferred money to his friend. His friend paid tax on it at 10%. His friend showed that I have earned 10% income. Right? 10% paid. Money came back to first person. What happened? How much did the tax go? 10% or 30%? 10% on income earned in India only, right? Let's say instead of his friend, he opens up a shop here. The first person opens up a shop here. That shop is closed. That shop is not even open. That shop doesn't have any furniture. He is just rented a shop here. What he is doing is, and when he opens a shop here, he will open a Mauritian bank account here and everything. Okay? So what he will do is he will transfer money from, let's say, SBI to his Mauritius bank account. He will pay tax at 10% to Mauritius government. That shop is not even working. Just imagine. It doesn't have anything. In fact, there is no shop. There is only paper. Okay? And then from that Mauritius bank account, after deducting tax 10%, 90% is then again remitted by his account to his SBI account. What is happening? He is earning here. He is transferring money there. He is paying tax there. And he is again transferring money here. Indian income tax authorities think that money is flowing from Mauritius on which already tax has been paid. Indian income tax authority do not see this piece of the transaction. Indian income tax authority only see this transaction or this particular part of it. Yes or no? Do you agree? Are you following this? What has he done? He has taken a round trip. Yes or no? Yahan se yahan and then again yahan se yahan. This phenomena is called as English. Round tripping of money by taking advantages of double tax avoidance agreement to pay less tax in the home jurisdiction to show that money has actually come from outside India after paying tax on that rate, 10% concessional rate, and now you can't tax that money in India because it is covered under double tax avoidance agreement. Actually, is it Indian money or Mauritian money? It is Indian money, but income tax authority sees it as Mauritian money. ठीक है? So this is a genuine transaction, first wala. Second wala is a round tripping transaction. So imagine how hard it is for income tax officers to catch these things. Income tax department is not going to go to Mauritius to check whether he really has a shop there or not, or he really has business there or not. है ना? Who has the time to do, who has the money to do that? Second transaction is round tripping. First transaction is a genuine transaction. This is round tripping. Now how to catch round tripping is the example, is the problem. How to catch round tripping? Tax information exchange agreements can be signed with Mauritius. Right? When money is flowing in from Mauritius, see, pay attention here. When money is flowing in from Mauritius, we can scrutinize it in detail. So all the FDI inflows or all the inflows which are coming to India from other countries have to be scrutinized in detail. Sir, what is FDI, what is FII, we will see in the markets chapter. Okay, those are very important concepts, they are very important terms. Amendments have been made to their acts and their legislations. We will see all in due course. But first, the focus is on taxation. Do you agree this might work? Round tripping happens. Do you agree round tripping happens? Okay? Now DTAA says, very interesting thing, DTAA says you cannot impose income tax on two incomes, like twice. So 1 year income tax is there, you cannot tax here. We are very smart. We are Indians. We are born smart. We put a tax here. The money will flow in India and we put a tax here. Okay? Then he is saying, sir, it is covered under DTAA. We are not allowed to tax me. We are saying, income tax department is saying, it is not income tax. It is a tax on all inflows coming in India, irrespective whether tax has been paid or not. All inflows coming in India, you pay tax. What is the nature of tax and whether it is direct or indirect tax, we will come to it. But do you agree with this? Now, see, there is another country here, let's say UK. Genuine money is flowing from UK to India. I told you yesterday, or I told in the last few lectures, that India is also an investment destination. So India is also an investment vehicle. So if investors, global investors, see that India is actually good, you can get good returns from investing in India, then they will invest in India. So genuine money is coming here, yes or no? There will be some people who are genuine who will invest from Mauritius to India, yes or no? Now how to separate between this and this, we don't know. There will be some people who are round tripping from UK to here, we don't know. What we did? All incomes, khatam. Tax all incomes, even this genuine income is getting taxed. Tax all incomes that are coming to India. Okay? One. Second, tax all incomes that are going out of India. Finished, end of story. Now does this discourage these guys? Yes. They discourage the green people, right? But at the same time they are helpful to catch pink people. Yes or no? Okay? Now this kind of tax, just don't think it from a double tax avoidance or income tax point of view. So let me put it this way. Lot of money is flowing in. Let's say UK se paisa aa raha hai, US is putting in money, Mauritius is putting in money. Some is genuine money, some is Indian money, we don't know. Okay? Is a lot of money pouring in India a good thing or a bad thing? It is a good thing because we are getting to use that money. Yes or no? Let's say today we get 20 lakh rupees, 20 lakh crore rupees. Today Indian government gets, or India gets 20 lakh crores of rupees. What will Indian government do? Indian government will do capital expenditure, Indian government will do revenue expenditure. Tomorrow that 20 lakh rupees wala says I am going out, which means I am pulling my money out. Is it good for the economy or bad? It is bad because it is very unstable. Yes or no? Do you agree with this? It is very unstable. So today if you get salary 70,000 rupees, tomorrow employer says I will give you only 700 rupees. It is bad. Okay? See, we need foreign funds for India to progress. We definitely need foreign funds for India to progress. There is no debate about that. We need foreign funds, sir, but those funds have to be stable. Yes or no? Now some of those funds are this thing. See, I have moved to a different topic altogether. DTAA and round tripping is done. Okay, I have moved to a second topic. Second topic is a lot of money is flowing from all over the world to India. India is becoming a very good destination for investment. Very good, sir. But today if it comes and tomorrow if it goes, it is harmful for us or not? Yes, it is harmful because, sir, we had plans for that money. If money is coming in, we had told that we will construct bridges, we had told we will construct dams, payment is done already. Now how can you take away money? To discourage this, what do? We put tax on inflow, we put tax on outflow. Then what? Then people will think before coming in. When they will be ready to pay tax, then only they will come in, and they will think before pulling out also. So whatever we get is genuine people, yes or no? These guys will be discouraged because every time they do round tripping, they have to pay tax. One while going out, one while going in. Genuine ones would also be discouraged, no doubt. But the actual ones who really want to invest, they will say, fine, I will pay this, I will stay here. And when I want to genuinely exit, then I will pay this and I will go. Okay? See, there are a lot of people who are coming, going, coming, going, coming, going. Because they are trading everyday basis. So they see today India is good, put money, tomorrow India is bad, pull money. Then again India is good, put money, again bad money. It is not round tripping, it is genuine investment I am talking about. But it is very unstable, yes or no? Today it is there, tomorrow it is not there. So it is like our studies. Today we are studying, tomorrow we are not studying. Today we are studying for 2 hours, tomorrow we are not studying at all. It is very inconsistent. Okay? So to discourage round tripping, second, to discourage this unstable flow of money, what we do is we put a tax on inflow, we put a tax on outflow. Now I want you to tell me what are the advantages of this. First advantage is round tripping is discouraged, because every time one gives money from here to Mauritius, it is taxed. One comes from Mauritius to India, it is again taxed. Round tripping is discouraged. What is the, this is the biggest advantage. What is another advantage is that only genuine investors come to India. Those who are interested in going out tomorrow, they will not come, because they will say today while entering also I have to pay toll, tomorrow while exiting also I have to pay toll. Okay? So genuinely, so if you really want to use, let's say I am just giving an example, if you really want to use a car or a laptop for 10-15 years, then you go for branded ones, yes or no? Then you pay that premium, then you pay that extra cost. Hai na? But if you want to, let's say in my example, I told you that big backpack which I purchased, I can buy even for 400, 500 and I'll just use it and throw it. Okay? So those who are interested in using and throwing money invested in India, they will not pay tax 2 times. Yes or no? Because every day, let's say if you are charged for investing and taking out your investment, you will not do that. But genuine ones who want to stay for a long time, let's say person A wants to invest for at least 5 years. He will pay tax once, and after 5 years, he'll pay tax and he'll leave. Person B, he puts and removes money 5 times in a day. He will not do this. He will not come here. 5 times he will not pay tax, and 5 times he will not pay tax. So one advantage is that genuine people come to India, they stay for a long term. It ensures financial stability. Yes or no? What is the biggest disadvantage of this? What is the biggest disadvantage? It discourages people. So earlier you used to get 100 crores per day. Now you are getting only 20 crores. These 20 crores are going to be with you for a long term. No problem. Or that is not an issue. But instead of 100, you are getting only 20 crores. So whether 100 unstable is okay or 20 stable is okay, that depends upon situation to situation. Yes or no? If you have to pay salaries, then use that 100 crores. Na? Tomorrow he will take away. Tomorrow find some new source. There are so many things available. Right? So see, because when a lot of people invest in India, even though temporarily, it increases the image of India. And then India can borrow long-term funds also, temporarily. So using these temporary sentiments, it can borrow for long-term from World Bank. See sir, so many countries are investing in India, though for 5 days only, but they are investing in India. Give me loan for 20 years. World Bank will say, yes, you are very good, right? But when we put tax, they will not come. You cannot say World Bank, sir, these guys are there for 20 years. World Bank say, I don't care, your image is not good. One biggest disadvantage or one biggest requirement for this to work is that, so why are they coming to India? These all people, why are they coming to India? Are there not other countries also for investment? There are other jurisdictions. There is Sri Lanka, there is, let's say, China. I would not say Pakistan, because Pakistan, kya hi kar lega? Let's say Spain, suppose. Spain is also but okay? So why are they all flowing to India and why not to China, Sri Lanka, Spain? They can do that. They can do that. Today, if we don't have tax, if we don't have this tax, will they flow to India or they go to outside India? They will flow to India. If we have this tax, then they will flow to outside India. So for this tax to work, this special entry exit tax, I call it toll tax. This special entry exit tax to work, that all flows you are taxing and all flows you are taxing outside or inside also. Every country should have such tax, yes or no? If every country has inflow-outflow tax, then we become attractive. But if we only apply this tax and these countries do not, then everyone will flow there. We will not get money. Okay? 2 terms, very important. One, we learned round tripping. More 2 terms I want to tell you. This money which is very unstable, might be round tripped money, might be genuine money. We don't know it. This money which is very unstable, today coming in, tomorrow going out, day after tomorrow again coming in, might be Indian money only coming in, but might be genuine UK money, US money, Germany money also. This money is very unstable. This money is very harmful for the economy, because today it comes in, tomorrow it goes out. We cannot base our fiscal policy on these temporary inflows. Yes or no? This money is called as hot money. This money is called as hot money. Why it is called as hot money? Can you tell? Why is it called as hot money? What do you think? Why is it called as hot money? Because it is coming in, going out, coming in, going out. It is heated money. It is hot money. So for example, I am an investor in UK. Okay, I invest today in India, tomorrow I remove and I invest in China. I remove, I invest in Sri Lanka. I remove, I invest in Spain, I remove. Okay? This is good for me but harmful for all these countries, because how will they plan their fiscal policy if they are not sure of the money ka duration? Okay? So this is hot money. Do you understand hot money? Okay. This special tax, we don't have this tax in India. We have to a lesser extent, but we don't have it in India as envisaged here. Okay? This is just a theory. I will tell you about this special tax in a while, but there was a professor, there was an economist, Professor James Tobin. Okay? He suggested this tax. You should tax inflow also, tax outflow also, and every country should do the same, and then only genuine investments will happen within the countries. This hot money and round tripping and all will cease. Okay? But why are the countries not putting inflow outflow tax? Because they need money. Because if he puts, he will not get money. If he puts, he will not get money. There will be some countries which will not put to attract money. Yes or no? After all, this is all a competition. Okay? This special tax, what is the definition? Tax on all inflow and all outflow of money, which was suggested by Professor James Tobin, is called as Tobin tax. Is called as Tobin tax. Is called as Tobin tax. T-O-B-I-N, Tobin tax. Is it cool? What is Tobin tax? What is round tripping? What is hot money? Everything should be crystal clear. We are again learning particle by particle. Okay? But you should know the meaning of these terms. Tobin tax is the tax on the gates of India. So any money flowing through the gates from outside and any money going from India to outside will be taxed. This is Tobin tax. Tobin tax is not used in our country. Tobin tax is a small version, a demo version of it is used in our country. I will tell you what it is. Okay? But full version of Tobin tax is not used. Okay? So far so good. We'll come to Tobin tax in a while. There was another professor called A.C. Pigou. His name was. He said, we have to discourage negativities in our negative environment in our economy, in our country. Your negative attitude is not good. So what are the negative things which happen in our economy? Cigarettes, negative impact wali things. What are they? Cigarettes, drugs, alcohol. What else can you think of? Anything else which causes a negative impact on the environment, on the economy? What do you think? Coal. Okay? Coal also. Right? Then all these ACs, the refrigerants and all of these things. He suggested tax these things. Tax negative externalities. So tax cigarette companies more. Tax companies who make alcohol more. Why? Because they have negative externalities, negative economic externality, negative environmental externality, negative social externality. Okay? Economic I say because sometimes they might result in losses. But obviously economic, they do a lot of profit, cigarette companies and all, they do a lot of profit and all. So economically nahi, but environmentally and socially they definitely are causing negative environment. Okay? These goods, bear in mind, these goods which have a negative impact on overall fabric of the country, be it social, political, environmental, these are known as, these goods are known as negative externalities. They are causing negative effect on the external this thing. Is smoking a negative externality or not? Does smoking cause negative effect externally? Someone can argue that I smoke, it is causing negativity to me only, others are not affected. But passive smoking causes externality, yes or no? So when you blow smoke, others also inhale the smoke and that causes passive damage. 1% damage, 1% damage, and then slowly it might affect you. So negative externality, anything which negatively affects. So remember the first lecture. Remember, did we speak about demerit goods? Did we speak about sin goods? Not all. Mercedes car is not negative externality. I mean, yes, pollution wise you can say, but so are all other cars. Yes or no? But so Mercedes car, you can say it is a demerit good, it is a sin good, it is a luxury, but it is not a negative externality. But cigarettes, drugs, alcohol, negative externality. This guy said tax this. We said okay, we will tax. Aap bolo, you are economist, you say we tax. This kind of tax on negative externalities is called as Pigovian tax. Pigovian tax. The tax on negative externality is called as Pigovian tax. Pigovian. Pigovian tax. Okay? Do you understand what is Pigovian tax? What is Tobin tax? What is Tobin tax? Tobin tax is a tax which is imposed on the entry and the exit of flow of funds from the country or to the country. Okay? From or to, outside, inside, anytime money is flowing in, flowing out, it is called as a Pigovian tax. Okay? Simple. Okay, very good. Now, in India, when you buy shares, achha, 1 minute. This Tobin tax is also known by some other name, which you should know. Then you will say, sir, you did not tell. FTT, Financial Transaction Tax, FTT. It is also called as Financial Transaction Tax. Then don't say, sir, you did not say, I found it in the book. No. See, the point is to understand the substance, to understand the concepts. And that is why I say reading to aapko karni padegi. You should read a lot. It is simply impossible to cover everything, each and everything of economics in these constrained time limits. But we try our best, and I am there always to help you with any doubts which you have. It is also known as financial transaction tax, right? So like I said, we have a small version or a light version of Tobin tax. So every time you purchase shares in India, every time you purchase any commodities, by commodities I don't mean you purchase goods. Commodities are also traded on stock exchanges. They are financial instruments. We'll cover them in stock market chapter. So anytime you enter into any financial transaction of share purchase or share sale, you have to pay some tax. Some part, 0.1 to 5% of it. And for Indians it is lower, for foreigners it is higher. So that is a smaller version of Tobin tax. Okay, whenever you purchase and whenever you sell, so whenever funds come in and funds go out, you have to make use of that. So they are called, see, now you should not remember these things. We will cover that in the markets chapter. They are called as securities transaction tax and commodities transaction tax. These are all in the nature of financial transaction tax. Okay? Securities transaction tax and commodities transaction tax. It's okay if you don't read them now or if you don't remember them now. We are going to cover them in markets chapter, right? Then I will give you a trick question for your homework also when we cover markets chapter. The question is whether this is a direct tax or an indirect tax. That is the biggest question. If you justify, then I will be very happy. I try to find out if it is a direct tax, and if you Google it, I am sure you will find 5 websites telling it's a direct tax, 5 websites telling it is an indirect tax. That is why it's a very tricky question. Okay. So now we have covered Pigovian tax, we have covered Tobin tax, we have covered what not, we have covered everything, yes or no? there are two key concepts which remain. One is minimum alternate tax, MAT बोलते हैं. There was a MAT controversy 1 or 2 years ago, and there is alternate minimum tax. Okay, there are these two types of taxes which are remaining, which we are going to cover in the next lecture, because this is too heavy now. Yes or no? Let us once quickly revise whatever we have learned today, because we have learned a lot of things. What did we learn in the starting? Two types of taxes: direct, indirect, incidence, burden, shifted, not shifted. Okay, very good. Indirect taxes, we have income tax, wealth tax, etc. Income tax, corporation tax also. What do you mean by tax to GDP ratio? Tax to GDP ratio is nothing but your proportion of tax as a proportion of GDP. What do we mean by tax to GDP ratio? Is buoyant, which means that increase in GDP is more than proportion to increase in GDP. Increase in tax is more than proportion to increase in GDP. Yes or no? What is India's current tax to GDP ratio? Combined 16%, central government 10%, half of tax, direct and indirect, 5, 6 is the half of percentage. Currently, it might change. Currently, income negative, indirect taxes are more than direct tax, but very small amount, 0.5% of GDP. Okay? Then we saw about debt to GDP ratio also, which is also debt to GDP ratio should be lower, as mentioned by NK Singh Review Committee. Yes or no? Then we spoke about tax to GDP ratio. Average in other countries it is more than 25, 30, 35%. We are stuck at 16%, so it is bad. One of the major reasons is agricultural income, because it is not taxed. Agricultural income is exempt under section 10(1). Then we saw tax expenditure. What is tax expenditure? It is nothing but your tax deductions and tax exemptions. Total milake you have tax expenditure. Yes or no? Very good. What is alternate scheme of devolution? Alternate scheme of devolution is devolution of taxes by the center to the states. Income tax, basically direct taxes by the center to the states based on the recommendations of Finance Commission. They will have horizontal devolution, they will have vertical devolution. Okay? Very good. Next, and it is recommended by Finance Commission. We are going to cover Finance Commission later on when we come out of tax. Now we are in the whole of tax. Right? Then what did we see? What else did we see? Sorry? ITR. We saw about ITR, income tax return we file with the income tax department. Then we saw the year in which income is earned is the previous year. Next year is called assessment year. There are 5 heads of income. One of them is capital gains, short term, long term ho sakta hai. Lot of deductions, exemptions are given, tax expenditure, we discussed it. Then we saw round tripping, very important. What is round tripping? Passage of money from one country to another and showing it as that it has come from other country. It is my money only, but I am showing it as I want it in Mauritius. Then what is double tax avoidance agreement? To avoid taxation of the same income 2 times, countries sign double tax avoidance agreement. Then what is hot money? Hot money is nothing but money which flows very rapidly between countries. So today coming in, tomorrow going out, that is called as hot money. How to avoid hot money? How to avoid round tripping? By imposing a financial transaction tax, also known as Tobin tax. It has to be imposed on entry, it has to be imposed on exit also. But the only key to success is that it can be imposed, it should be imposed by all other countries, then only. We have certain elements of that called as securities transaction tax and commodities transaction tax. Small light version, we'll speak about it in markets chapter. What is Pigovian tax? Tax on negative externalities. Sir, can you give an example of Pigovian tax? So we currently have a tax of 500 rupees on per ton of coal. Okay? We have an example of tax is 500 rupees per ton of coal. So every ton of coal which you mine, you have to pay some cess, clean energy cess bolte usko. 500 rupees. It keeps on changing. It is depending on the quality, depending on the pollution. So if it pollutes more, you have to pay tax more. If it pollutes less, you have to pay tax less. Okay? Then what did we study? Then we studied about, what did we study? We studied a lot of things. We studied about POEM, place of effective management, to determine the place of effective management of a company. Then we studied something called as GAR, General Anti-Avoidance Rules. They specifically empower income tax officers to disallow a transaction which is made only for the purpose of anti-avoidance. General Anti-Avoidance Rules. Then we saw BEPS, base erosion and profit shifting. Whose base is eroded? The country in which actual profits are made, but it is shown in some other countries. So the country in which, MCQ, the country in which tax rate is dash, its profit is, or its base is eroded. Tax rate is high or low? The country in which tax rate is dash, its base is eroded. Tax rate is high. For example, in India, tax rate is high, base is eroded. The profit goes to whom? The base increases of which country where the tax rate is low, that is base erosion and profit shifting. This base erosion profit shifting agreement forms a part of OECD framework. Okay, OECD. Then again, to control this, we have now come up with a new agreement which is Global Minimum Corporate Tax Agreement, which is still in discussion. Approximate 15% is in discussion. It was initially floated by G7, then taken up by G20 and now taken up by OECD also. These are all groups of countries. Okay. Then what did we see? What else did we see? Can we remember anything? Transfer price, very important. We saw transfer price. Transfer price is nothing but price which is used to transfer one goods from one group company to another group company. It can be subsidiary to holding, it can be holding to subsidiary, it can be subsidiary to fellow subsidiary. Okay, we saw all that. Transfer price can either be arm's length price, which is determined by the market, or it can be a sweetheart price, which is specifically designed to avoid taxes. Then we saw tax evasion, tax avoidance, and tax planning. So those are the three levels of chori which you can do. Tax planning, no chori. Tax avoidance, thoda sa chori, and tax evasion, complete chori. You know. Then what else did we see? Can we remember without looking? That is the challenge here. See, by looking in your notes, anyone can tell. Even I am not rewinding this. Do we remember anything else? We saw tax havens. We saw low interest, or sorry, I always say interest. Low tax rate regimes are called as tax havens, right? Then we saw, what else? Very important, we saw advance pricing agreements between Tata and government. Before only they decide the price, advance pricing agreements. Okay, we saw APAs, right? I think we covered everything. So let us, this all we have covered. Round tripping, hot money, Tobin tax, financial transaction tax, everything is covered. Then we covered Tata Motors, holding company, subsidiary company, sweetheart price, transfer price, arm's length price, market price, we covered everything. We covered POEM, we covered APA, we covered GAR, we covered BEPS, we covered DTAA, TT shopping which we left. TT shopping is nothing but choosing of treaties by the potential tax evader and to take advantage of it. This is very general. Mutual legal assistance treaty between countries and tax information exchange agreement. I am giving you these words because MCQ will come so easy. You know what MCQ came? What is BEPS? Aisa MCQ came. It's so easy. Okay, and these words you have to use in your answers also. So this forms a combined study of your prelims as well as your mains. Uske pehle kya hai? GAFA tax we saw, which is mainly used by mainly tax imposed on e-commerce companies. Then we saw global minimum tax rate. This we have seen tax havens. What is this? BEPS, we have seen BEPS also. What is this? Tax buoyancy, we have seen this. Tax expenditure, we have seen this. So far everything we have seen. We will continue with the difference between surcharge and cess tomorrow. We have to continue with minimum alternate tax and alternate minimum tax also in the next lecture. And then we finally move on and finally jump on to the world of indirect taxes. Indirect taxes are very easy to understand. Indirect taxes will hardly take 2 hours. One lecture, indirect taxes, and then we move. For 1 hour, we move back to financial policy, fiscal policy. We speak about finance commission, which we saw, and then we again start with marathon chapters, which is monetary policy, inflation, and banking. These three go hand in hand. MIB, Men in Black, monetary policy, inflation, and banking. When these three are covered, you can say that conceptually you know 60 to 65% of economics conceptually. Then we will have balance of payment, which is a big chunk, which is more 10%, 75% ho gaya. And then World Bank, WTO, IMF, these are all small things which we will cover, right? Then we have to cover agriculture also. So it's a long journey ahead. We are in the 16th lecture now. So expect 35 to 38 lectures, more than double lectures at least, right? So I hope you understood each and every grain of it, each and every particle of it, and why it is done. See, more than the term, the reason is more important than the term itself, right? So we'll again begin with the revision in the next lecture, so that it keeps on getting hammered in your brain, and by the last lecture you are very comfortable with it, right? We'll stop here. I'll see you in the next lecture. Thank you very much. Keep studying, keep revising.